In today's video, we're going to be talking about tax planning strategies that you need to know for retirement. We like to think of this as either taking the IRS's plan or either taking your plan. As we all know, the tax code is very in-depth, and we always ask how many people have actually read the tax code. And of course, the answer is typically not many. The good news here today is we're going to be opening up that tax code and sharing opportunities that are within there for those who are preparing for retirement. So the goal after this video is to take action on what the tax code says rather than being a victim and saying, I don't know what's out there, you don't know what you don't know. Well, you've got to be a good steward and you've got to be good at searching and researching, and that's the whole point of this video, and that's why you're watching. And so today we're going to go through those strategies and hope that you can take advantage of some of these for your retirement.
Joe knows taxes.
Joe knows the market.
Joe knows Social Security.
Joe knows income planning.
Joe knows pickleball? No.
This is Joe Knows Retirement.
Now, if this is one of your first times watching our YouTube channel, my name is Joe Schmitz. I'm the CEO and founder of Peak Retirement Planning. We are a comprehensive financial planning firm who focuses on those who are in or near retirement, those between the ages of 55 to 70. And that's what this channel is designed for. And we work with people all across the country, so we know that everyone has different situations. And so part of this video is to help those who are called Midwestern Millionaires. And this is a term that I've created myself, and I'm actually writing a book about it right now, and it will be out either later this year or early in 2025. And it's all about those people who have been hardworking, they've been frugal over all their years, and they typically have Midwestern values. And you may say, I'm not from the Midwest, I can't be a Midwestern value. Well, no, actually, we work with people all across the country who have Midwestern values, even though they may be from the West, or the East, or wherever they may be. And so the key is, do you have those traits? And for the Midwestern Millionaire, they've been diligent savers. And so there comes a lot more planning opportunities for those folks. And so that's what today's video is designed around, is we're going to be talking about strategies that are a bit more advanced that we would encourage those with $1 million or more to start looking into. And remember, this is just general information. I don't know your specific situation. And so that's part of the video is you have to do and see, hey, does this make sense for you or not? And you're going to want to make sure you pay attention and stay till the end, because at the end I'm going to share one of the most popular strategies we're seeing here today, and we're going to also talk through how you may be able to take advantage of that. So for the first strategy that I want to discuss here today is what we call tax location. Now, if you haven't heard of tax location, we like to consider the three buckets of investments. You have the taxable bucket, you have the tax deferred bucket, and you have the tax free bucket. Now, all three of these buckets are different. The taxable bucket can either be taxed at ordinary income or capital gains. Now, this is only typically on the growth of the investments in the taxable bucket. So think about your bank accounts. When you get interest each year, you're going to have to pay tax on that interest as ordinary income tax. Or you could think of this as maybe your brokerage account, your joint registered account, your single registered, maybe it's named in a trust. In these accounts, you have to pay tax at capital gains on the growth, which can be anywhere from 0, 15, 20%, could be more depending on your situation. And so that's what you need to be aware of in the taxable bucket there. Now, tax deferred, as we all know, that's where most people's wealth is. That's going to be the 401ks, the IRAs, 457, TSP if you're a federal employee, maybe deferred comp if you're a state employee. And so with these accounts, you have not paid taxes on it yet. When you put money in up front, you got a tax deduction. So if you put in $10,000, you saved on $10,000 a day, but now this has grown to $100,000, and now when you take out $100,000, you're going to have to pay taxes on that full $100,000. And then we have the tax-free bucket. Now, it's not necessarily tax-free because when you put your money in there, you've already paid taxes on it. So if you put $10,000 in, you've paid your tax, now it grows to $100,000, now you take it out, no tax at that time. And so that's the way the three buckets work. Now, obviously, everyone wishes they could have their money in tax-free. If they had a magic wand, they want everything in that bucket. But we just know that that's not going to be fully realistic, right? And nor do we typically recommend to put all your eggs in one of these baskets. If we move everything from our 401k, let's say we have $3 million in our tax-deferred bucket, we probably don't want to shift that all over to tax-free in 1 year, because that's going to be a huge tax consequence. So I want to teach you how to utilize these three buckets. Now, we do see that not enough people have money in tax-free. We see a lot of advisors that not necessarily are advising on it. And it's not necessarily because it may not make sense. It just may not be an area of specialty. And so if you're doing this on your own, have you been making these moves to move more to the tax-free, moving from your taxable to tax-free? Again, not all at once, not everything, but we typically want more of a balance among these three accounts here. And so, with the clients we work with, we like to see more of that balance. So let's just say we do have a balance in these accounts. Typically with our clients, they don't want to have everything aggressive, right? The Midwestern Millionaire, as we say, can take as much risk as they want, or they could take as little risk as they want. And the reason why is because they've reached a point where they're financially free. We can run reports and calculations and show them that if they just average a 5% rate of return over their lifetime, they're going to be successful. Their goals are going to be met. We could show them that if they wanted to have everything in the market where it goes up and down over time, they could still be successful. They may end up with a lot more money at the end of time, or they may end up with lesser. And so there's a lot of things that go into that conversation, but for the clients we work with, they typically want to see more of a balance between those two. So what I'm going to tell you with tax location is, how do we want to have our investments in each of these three buckets? And so for tax-free, we typically want to have more of our aggressive type investments. And you're probably thinking, well, I'm not aggressive at all. That's fine as well. Think of more of your growth-oriented investments, maybe the S&P 500, maybe different Vanguard ETFs that are focused on growth, maybe some individual stocks in that tax-free bucket. So with a lot of our clients, we'll look to get more tactical in that approach there. Yes, we may have more losses at certain times, but our goal is long-term for that tax-free bucket. Now, maybe we don't have everything aggressive in case we're planning to take from that Roth within the next 5 or 10 years. We have to be smart about the risk that we're taking there, but you get the idea. If we have 100,000 today and it doubles to 200,000 based on the rule of 72, right? If you get a 7% return, it'll double in 10 years. Now, if it's 100,000 goes to 200, there's no tax on any of that growth. So we'd want that money in the tax-free for all of that money we're expecting to grow over time. Now, what about the tax deferred? Well, we obviously want to see all the growth in the world, and that's typically what we'll try to shoot for. But if we are going to want to be more conservative, as we know with conservative investments, the less risk you take, the less return you get, although you get more predictable, stable returns over time. And so if that's what you're thinking, hey, I want to take a portion of my assets and I want more protection, typically we would do so among the IRA or the 401k or something that is going to be taxed ongoing. It's the same concept. If you have 100,000 a day, maybe we wouldn't expect this to grow to 150. Remember, it's protected, so it could serve its purpose, but now we only have $50,000 of gain to pay taxes on versus 100,000 over here. So if you're looking to have a balance, why wouldn't you do it in that way to take advantage of the current situation? You also have to see, where do you plan to take out money, right? And we call that, tax efficient income planning, is which of these buckets that we're going to be taking out from also plays a point here of how you're going to invest all of these. If I plan to take out my Roth in 3 years, as I mentioned, that's going to have to be more conservative, even though I want long-term growth in that vehicle. So keep that in mind for your particular situation. And then now for the taxable bucket, we typically want to be smart about how we do that. I already explained to you earlier about the difference between ordinary income and capital gains. Capital gains for most people are going to be much more favorable. If you're in the 12% ordinary income bracket, you could be in the 0% capital gains bracket. If you're in the 22 or 24% ordinary income bracket, you're typically in the 15% capital gains. So I know that's a hard math equation for you, but what would you rather pay? 0 or 12? 22 or 24, or would you rather pay 15? And so for most people, they'd rather pay capital gains. But the other consideration here is, if you invest this money tax efficiently, you could be investing in either individual stocks or ETFs where they're not going to have what we call phantom gains. They're not going to make changes in trades every single month or day or whenever. And so you can have more control over that tax bill. And so you could let this grow and maybe have no tax consequence until either you pull that money out, or if you pass away, you could get a stepped up cost basis to really make that advantageous for you. And so if that's you, just make sure you're aware of that. And what I really want people to be aware of is, if you have this taxable bucket in your bank account, or maybe in a money market or a treasury or a CD, again, you're going to have ordinary income. So maybe instead of having our protected vehicles there, I definitely understand the value of protected vehicles. Maybe we do that in the IRA, and then we can have our tax-free and our taxable, more growth oriented. So again, you're taking on the same risk. You're just doing it in a wiser way. So that would be our recommendation with the tax location investing there. Now, the second strategy I want to talk about is what's called a donor advised fund. And we can kind of go off of that taxable bucket as something that we look to utilize with this. So this is going to be if you're charitable minded. This and the next strategy is if you're charitable minded. If you're not, feel free to skip through these next two strategies to jump to, the strategy number 4 there. But with a donor advised fund, you can take parts of your non-qualified account, for example. Let's say you have Apple stock and you bought it for $10,000 and now it's worth $100,000. Well, you could take that Apple stock and you could sell it off. And if you do that, you're going to have to pay a tax consequence of capital gains of maybe around 15%. Or you could take that Apple stock and you could put it into a donor advised fund and then sell it off. If you do that, you remove that 15% tax. You nearly saved about almost $15,000 there because you don't have that tax. That's benefit 1. Benefit 2 of a donor advised fund is now you can give from that fund as over many years as you want. Typically, we recommend to give up until 7.5 teaser for the next strategy. And so that may be something you want to look at is how much do you plan to give from now and 7.5, and then do all of this in 1 year so that you get to itemized deductions. That's point number 2 of why this is advantageous. If you have a $100,000 itemized deduction this year, then you're going to be over the standard deduction, and you're going to be able to utilize this strategy to offset some other taxable implications that you may plan for, or maybe now you can do other strategies to layer these together. And so that's something that we do with a lot of our clients. So I want people to be aware of a donor advised fund for those 2 reasons. I have other videos on donor advised funds as well if you want to get more granular there. But from a high level, that can be a very important tax planning strategy for people to use as they look to save money throughout retirement. Now, as I already teased, point number 3, this is going to be qualified charitable distributions. Now, you can't do this until 7.5, and we know most people that watch these videos are not 7.5, and that's totally fine. But you still need to start planning for it. For example, if you're 60 years old, that's going to be 10 years away, although we need to make sure that we have enough in our tax deferred bucket to be able to give to the charities. So if we want to give $10,000 a year, we need to have enough money in that to give from 7.5 until we pass away. And so that could be one of the advantageous strategies there. And then once you're age 73 or 75, depending on when your required minimum distribution will be, if you're born in 1960 or after, it's 75. Everyone else, it's 73. But instead of taking a $40,000 RMD, give $10,000 to the charity, now you're only required to take out $30,000 from your RMD that is counted as income. So it can be a very wise strategy at that point to not only accomplish your charitable gifting, but save your tax money, right? We never want to give just for tax planning benefits. Hopefully it's out of the goodness of our heart, but we might as well get the tax benefits if we're going to do it, right? I'd rather see the charity get more money than Uncle Sam is my personal conviction. But that's also why I wrote the book, I Hate Taxes, right? And so that's, something that you've got to decide for yourself of what type of planning you want to do there. Now, a 4th strategy, which is very well debatable, so I'm not going to make any hard stance here. I'm just going to throw this out as an idea, and then you're going to have to do what you need to with this because I'm not sure of your particular situation. But something that we could advise our clients to do is wait to take Social Security. That could be a tax planning strategy to set them up for retirement. Now, you can't take Social Security from 62 to 70. As we know, if you wait till 70, you could see nearly double the amount of benefit versus if you take it early at 62. But we do know the negative of that is you go 8 years without payments. And so we all know the break-evens right around age 80 to 83, depending on how you calculate it. And so are you going to live past that time or not is really one of the considerations. But let's look at this a little more intentionally. So from a tax planning strategy, if you're going to do Roth conversions between ages 55 to 70, for example, or really 62 to 70, if you take Social Security, what's that going to do to your income? It's going to raise it up. And that's going to leave you less room to do Roth conversions, for example. And so if that's the case, maybe you wait to take Social Security till 70, and now you have more room to move money from tax deferred to tax free at lower tax rates. Or you have other opportunities from a tax planning standpoint that you can utilize as you use up that lower brackets. You may be right now in the 12% bracket. If you take Social Security, maybe that's now going to force Social Security to become taxable, and now you're going to have to pay more in all-in taxes. So if that's a goal of yours, that could be an advantageous opportunity. Also, as we know, the widow's penalty is a big deal when one spouse passes. one of the Social Securities goes away, you do get to keep the higher of the two, which again can make that waiting till age 70 advantageous, is to make sure that spouse is left with the highest benefit possible and knowing those are going to go away. So those are some considerations there. And now for the last point, which I just teased in the last one, you can kind of see the theme of this video here, but it's Roth conversion. That's the final point that I want to talk about here today. And this is one of the most advantageous strategies that we're seeing right now for that Midwestern millionaire. Again, most of them have their assets in tax deferred vehicles, and now could be a wise time to start to shift them from tax deferred to tax free, which is ultimately what a Roth conversion is. Now, if we do a Roth conversion, what do we have to do? We have to pay taxes. And so that's why it's important to do an all-in analysis to see what's going to make sense for your situation. We always want to pay the least amount of taxes, right? And so we need to do a calculation report to see what this is going to be long term. And when this is implemented correctly, we've seen with a lot of people that we work with, this can save hundreds of thousands of dollars for that Midwestern millionaire over their retirement, for their spouse if they pass away, or even their kids when they pass away. So it can be beneficial for them, their spouse, and their kids, or even grandkids if that's their goal. And so this is something that we're recommending everyone to look into. Now, if someone has less than $1 million, this may not be as advantageous unless maybe you have a pension, and then that's where it's really gonna be advantageous. We work with a lot of people with pensions that we're looking to do Roth conversions with. And so if you have $1 million or more, especially like I said with a pension, definitely going to want to look at this pretty intensely, because your income's probably not going to be lower. And even if you have no pension, if you have $1 million or more, you're probably going to have RMD, Social Security from a high amount from all your earning years, and now you're going to be forced to be in either the same tax bracket or potentially even higher, depending on how much you have saved up. And so that's why you can choose with this Roth conversion to pay the tax now versus later. Allow yourself to have a lower tax situation in the future, could set you up for success there. And again, it's all about diversification. Let's go back to the 3 buckets in a tax efficient location that we talked about earlier. Now, we may want to look to balance. If we have all of our money in tax deferred, maybe we shift some to tax free so that we have more control over our retirement. So we can choose which one we want to take out from. Remember, IRS's plan versus your plan. Your plan is going to be allowing you to have the idea of when to take it. We also talked about tax efficient income planning. If I have the 3 buckets here and I can choose which one I want to take out from, now that's going to allow me to really pinpoint how much tax I pay in retirement. You got to remember, you have the standard deduction in retirement. You've got different tax brackets. You've got Medicare premiums. You've got Social Security. Could be taxable or tax-free depending on your income. I like to, for the clients we work with, we like to make sure that we can have the choice so that we can strategically keep our income low enough to avoid a lot of those taxes, unnecessarily taxes as we call them, if we can just plan the right way. And the way we do that is by planning right now with some of these tax planning strategies that we've talked about, but there's also many more as well. And so if you're looking for further help with these types of tax strategies, feel free to schedule a call with our team, and we could see if we could help you ongoing if you're looking for a trusted team to serve you ongoing. We don't work with everyone that schedules a call with us, just to be very transparent, but we want to ensure that we can give the right guidance and see if this could be a good opportunity is something that we look for. And if you could write in the comments what your thoughts are on these videos, that's just helpful for me to get a gauge of, what do you want to learn more about? What did you like about this video? What could we have gone through deeper? That would have been great. And as you know, if you've been watching these videos, this may be the first video you see me with actual facial hair. And so I'd love to hear comments on what your thoughts are on that as well. And should I shave it or should I keep it, right? I'm typically a clean shaven guy, but I'd love to hear our avid viewers from all across the country who I don't always get to interact with of what your thoughts are. So we'll have some fun here, and that's what you can expect in this channel if this is your first time watching. We're going to make this very particular to help as many people as we can and ensure that everyone's educated and informed with the decisions they're making in retirement. So enjoy the rest of your day and continue watching these fun videos.